Okay, so we're going to just spend some time going through the mining scenario for triple net construction. And we always start off with the leverage. Oh, by the way, this is somebody that's either buying a property with a single tenant, triple net, client pre-leased, long-term lease that he or she is going to build. So the leverage we always start off with, let's say they're around 65% loan to cost. That would be fairly standard if you're doing anything with a bank type of lender. If it's somebody that is wanting higher leverage, that's doable. You can go up to sometimes 90, 95%. The challenge is that the tenant really has to be a pretty renowned tenant. So, a household name, very strong tenant, and we're talking 50 to 100 million plus in top line revenue in order to really get higher leverage, for something like that. So for the recourse, in many instances, you can do during construction. You will not do non-recourse. It's always what's called a completion guarantee. So that means they're going to have to guarantee during construction, but more than likely, as soon as the tenant occupies, they can go to full non-recourse under the pretense that, again, the tenant is a major household tenant. So from a pricing perspective, if you are doing something that is bankable with lower leverage, you can get fairly aggressive on pricing. If you're going with higher leverage, where they're trying to do something a little bit on the high leverage, so it could be 80, 85% loan to cost. In that particular situation, you're going to be more in the 10%. So it's going to be, probably in those range. From a timing perspective, if you're going with more of a private institution, you could close in 30 days. I think that's realistic. If it is a normal bank, you're probably 60 plus for those. Could be a little bit more aggressive, but I think that's safe to assume. The asset type, location is major metropolitan. That's a big deal because, again, the tenant plays the majority of the role in this, but if they're in a major metropolitan area, it's going to be much better because the lender feels more comfortable. There's a bigger market. If something goes south, then they'll be able to come in and do something with that particular tenant. Smaller markets, again, like a Dollar General typically goes in smaller markets. It's not necessarily bad, but it's just something that we would have to be, cognizant of. Square footage, you want to know square footage, land size, building metrics, the budget. Is there a construction budget? Who's the contractor? When are they supposed to have their permits to go vertical? Where are they at in the entitlement process? So those will be important information. Who's the tenant? They, local mom and pa or major, credit tenant. Strength, sales numbers, financials, balance sheet. We need to see that on the tenant. Length of the lease, if there's any out clauses. And then just client reality experience will be a big deal. Have they done this before? And if they haven't, again, that's not necessarily a deal killer, but there might be some offsetting factors like their net worth. The size of the loan, not overly worried, but call it $1 million plus. If it's different size, bigger is better. Not an issue there. Net worth should be strong, at least 1.5 times the loan amount, I think is a fair assumption. But they should have, cash, 6 months of post funding reserves. If they have outside cash flow, that could be helpful. Again, this depends on if you're dealing with a bank. Banks are going to want to see that. Private institutions are not overly worried about it. So that's something to look at under those pretense, or those situations, I should say. Business cash flow, we're looking at the tenant as the source of repayment. So the lease will be what you're looking for. Ownership, again, you're looking for partners. How many partners? Who are they? What's the ownership? You just need to dive into those details. Equity, where's the cash coming in? We need to see that and understand, is it 1031 exchange? What happens if they don't have the cash? So after all these come back, we're talking about probably going to a bank, probably going to a fund of some sort. There's triple net funds specifically. So that's kind of what you're going to be doing with triple net construction for now, for Integrity Capital.